You're about to hear my conversation with Benoit Gervais, portfolio manager and head of Mackenzie's resources team. Today, we'll talk about the conflict in Iran and the near-term implications for energy prices. We'll also discuss longer-term implications for the energy complex if we have a longer-term conflict, and we'll close with a conversation on the role of geopolitics with respect to the world's critical minerals industry. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, head of portfolio construction. Today, I'm joined by Benoit Gervais, portfolio manager and head of Mackenzie's resources team. Benoit, thank you for joining the podcast today.
Thanks for having me. Happy to be here.
Benoit, I want to get into a conversation with you, and I just want you to give me the straight goods, specifically the Strait of Hormuz. Lots of headline risk given the conflict in Iran. Geopolitical risk premiums have been built into oil prices. How should investors think about the geopolitical premium that is in oil prices right now, given the conflict in Iran?
So the world is a multipolar world, like we've been commenting on over the past couple times we've met. And this is just amplifying the same signal. The commodities in general are more and more treated differently according to their source of origin. In this case, Middle East has been a long-term supplier of energy to the world. It is a staple to the rest of the world. Europe was comfortable enough to source it there when they were turned off on Russian gas, not that long ago, turned to the US and turned to Qatar to get extra liquefied natural gas, and continues to get most of its oil, and the rest of the world, same. A big chunk of their oil is coming from the Middle East. So now we're in a conflict region, and people are rethinking not only today on how they will face demand for just about this week, but I think the broader implication will be day two when peace breaks out. What will that supply chain look like? Will we stick to the usual mix of Middle East and the rest of the world, or will we try to diversify or look inward? A little bit like we've discussed in the past, which is this global tariff war has caused many countries to look inward or look to new partners and strike new friendship in order to diversify. So we are highly dependent on energy, just like we're highly dependent on China and some minerals. I think people are rethinking the whole supply chain is who's my friend, who's not, who's dependable, who's not, what is the premium I'm willing to pay to secure my supply chain, and so on.
Very good. Now, I'm going to get to the substitution effects with you in a moment, but from the seat I'm in, Benoit, I find it hard to believe that we're going to go from a pretty significant geopolitical risk premium right now to the lack of a geopolitical risk premium, say even a month ago. Should this conflict end in the near term, do you think there's an element of a geopolitical risk premium that could be lasting at least through much of 2026?
Yeah, I was trying to get there, probably didn't get there clearly enough, but if you had to ask me for a number, I would say $5 to $10 over the long term. So when we're talking the long term here, and the commodity space is 1 to 10 year, not just the immediate next 12 months, but rather year 2 to year 10, what is that new average premium should be to make sure that is not disruptive? And that's the incentive that you give to market to say, well, maybe you should store a little more. Maybe you should produce a little more, because we cannot be as dependent as we were before this war broke out. And the same thing goes for gas. So we went through this just recently with Europe. So Europe says, I am willing to pay extra and attract international cargoes of natural gas in order to diversify away from Russia. It's a replay of this. We're having a replay of that. If you think about it, all the critical minerals, right? There's copper here in America or aluminum here in America, and there's copper and aluminum elsewhere.
Very good. I am going to get to critical minerals towards the end of our conversation, but I'm going to stay on oil just for a moment. With respect to replacement supply, if supply from the Gulf is disrupted, is there even a source for replacement barrels? And if so, what would be the composition by location for potential replacement barrels? Or does the rest of the world just not have that capacity?
There is some strategic reserves around the world, unless we can put some numbers around this. So the shortfall that we're facing today is about 10 million barrels a day that's getting disrupted. The whole region is producing 20 plus or minus. Some of that is not having to go through the Strait of Hormuz. And that leaves us with a deficit of 10 million barrels. And for easy math, about 10% of the total crude market, crude and crude product markets. Now, the available inventories, many of them are sanctioned barrels, which have become unsanctioned, right? Getting waivers. Then there's about 150 million barrel of sanctioned and unsanctioned sitting on the water that's readily accessible. So that gives you the first 15 days. And beyond that, now that it has to be in that sequence, beyond that, then you're going into strategic reserves, whether they're sitting in China, which has been accumulating over the years, and the US, which has a published number that's very reliable. But all of those strategic reserves, depending on their location, have different capacity to be drawn down. So it will come, if they come out, those barrels will come at a much higher price, obviously, and will trickle out. So we're more thinking that there's going to be demand disruption with the oil price exceed $100, so call it $120, and that's where we were last time when we had demand destruction. So a combination of a trickle out of strategic reserves, some sanctioned, unsanctioned barrels sitting on the water, so draw down those inventories, which were above average. And if the conflict is still persisting after those 10 plus days or 20 days from here, from today, mid March, then we're going to have to be facing more difficult choices and looking at some stay at home type of policies. And we're starting to see some of that in the emerging markets where purchasing power is lower, like Bangladesh or Pakistan or Vietnam, places like this. And that demand comes back. It's not like it disappears forever, but it does precipitate the bigger question, which is the energy transition towards electricity. And that will reinforce that thematic and encourage government and industries and individual to migrate just a little faster on the other side of this.
Very good. Benoit, you've already given me the material for my next two questions. You mentioned $120 peak the last time we had a geopolitical risk premium. If we go back through history, when we have these events, we certainly have a surge in prices, but eventually some form of normalization. From your seat, what do you see as the realistic ceiling for oil prices if the conflict persists? And as we talked about before we came online, I know you have a strong following in both the retail and institutional world. So I know many people will be very curious as to how you are looking at this situation from a price perspective.
Over the short term, you have demand destruction in the 100 and call it 120 to $150. And that's a nominal number that we pulled from previous crisis. So you could make the argument today after inflation and fossil fuel like crude is a smaller proportion of the average wallet, that number could be even higher before you have substantial demand destruction. That's the short term. In the long term, then the substitution, I think, happens above 100 in general. It's simply because we wanted to substitute away anyways. And I think there is this aspect, this built in premium now that we're going to attribute to energy sovereignty through electricity. And that plays up, if you want, all the critical minerals, if you and other technologies. And that we have to address. That will be the long-term substitution effect.
Very good. And as always, Benoit, you and I continue to be perfectly aligned in this conversation. You don't even know what my questions were going to be, but my next one follows on what you just said, and that is on second order effects. So, As a function of this crisis, however long it lasts, what are going to be the second order effects beyond growth and inflation? I'm thinking really with regards to the energy transition, with regards to investment, and closer to home, it might even be with regards to the project approval process. Truly, what do you think the second order effects are going to be of this crisis?
Gradually but surely, the Western world is coming to grasp with this multipolar world, which we haven't been in for some time now. The need for reindustrialization, having better infrastructure, having energy sovereignty. Energy sovereignty means very often renewables. And then in that case, China is controlling many of those technologies. Some laws and some incentives exist in some countries like the US and Europe and slowly in Canada, but probably not enough in practical ways that we can say clearly we can take actions today that will result in outcomes in a year or 2 years. So there is, even here in Canada, still disagreement across provinces about who gets what, where, what's a priority. Should we encourage a pipeline across provinces? I think there's still division there. And that's energy sovereignty. It's not renewable energy, but it's energy sovereignty. And who will get the refinery for critical minerals? Who will get the big mine? I mean, those are not pleasant industries to have in your backyard. So we're here at this juncture, and this crisis is amplifying, as I was saying earlier in this interview, is amplifying that signal and is making the choice more obvious again. So the second derivative and the third derivative is clearly to invest at home or with friends. Whether you're in the energy business or you're in the second and third derivative from the energy business.
Benoit, just yesterday, you and I were discussing a recent article that was published in The Economist. And this particular article put forward the case that a lot of the investments that is occurring on behalf of the Western countries into critical minerals is more about geopolitics and future supply chains than current state demand. What is your take on this position?
We have written a white paper that resembles that of The Economist. So we are broadly in agreement. Those who are interested in reading that article is a good article, a good summary. I think that China is controlling too much of the supply chain when it comes to critical minerals and renewable energy solutions. And by that, I mean that the country, many places around the world produce copper. Very few can deal with the concentrate and turn the concentrate, which comes out, by the way, for those who don't know, a copper concentrate ranges in the 20s of percent. They still need 4 tons of concentrate to turn it into 1 ton of pure copper, which is then usable to make wires and other solutions. And then from that finished copper state, you want to make really what you're interested in is all the little parts that will allow you to meet, let's say, a solar panel or an electric car. And 80% of that entire chain, or there those in solutions, whichever solution you're talking about, is dominated by China. And we were quite happily buying from them because they are very competitive. They have some technological edge and they were friends. And now we say, well, maybe they still are friends, but maybe 80% is too much.
Very good, Benoit. Thank you. Now, follow up question with respect to the entire critical mineral space structurally. Is there a particular area of this market that should be, you think, of greatest focus? So, is it all of them, or say if I take some of the leading ones, most people who are listening would be familiar with copper, lithium, nickel, uranium, or others that you think that the West should focus on? What are your thoughts there?
Well, the world needs the Western world, that is, it needs to focus on the economy of doing rather than the economy of knowledge. That's where we've been focused on. I think we've sent all of our children with that in mind, less about trades, more working at a desk. And I think it was a reflection of where we were. And today we're saying, well, we'd like to have control over those supply chains, which is more about this economy of doing. And we need the infrastructure and then a whole secondary economy to support it. And those are not ships that you can turn quickly. You need an army of people. You need a culture of doing rather than thinking. So we definitely need to diversify. We still need to have trades, but with more partners, right? And find where we have this competitive edge. In this case, here in Canada, to talk about our competitive edge, we're really well endowed. There's no doubt about it. We have not been very good at transforming this geological endowment in anything downstream. Our aluminum, made from hydropower, is still leaving this country in bricks. That's as much transformation as we've done. And I think there's opportunities here for transformation at a minimum. Same thing goes for lithium. At the moment, it's going to leave as its concentrate, no transformation, right? So I think that if we can focus on this, on using it, rebuilding an infrastructure, rebuilding skills and trades, then it's a win-win.
Excellent. And in fact, I want to follow up on that and to use at least one pun. Let's dig in on that when we go into the critical mineral space. And actually, let's use that as the ending point of our conversation. There's also a lot of evidence that suggests in the West, there's a lot of focus on exploration, development of extraction, but not enough focus on refining capacity. And refining capacity is still controlled by China. And as a result, that makes the rest of the world susceptible to China being the price maker. Is this really a significant risk that the West is overlooking, the lack of refining capacity outside of China?
You're picking on a good example here, which is symptomatic of this whole supply chain discussion that I was describing earlier. Today, people will pay you to take your concentrate and turn it into finished copper. And that state of affair is present in many other industries that are highly subsidized by China. They're already quite competitive, but on top of that, some industries are actually don't mind losing money, perhaps because of subsidies, or perhaps it has strategic intentions behind it. And they're not controlled by shareholders and so on. And that makes it very uninviting for any return seeking enterprise. So if you wait for that signal, then you will never build a refinery or a smelter. And I think you can look at the state of affair, whether it's in Rouyn-Noranda or in Sudbury or at Trail. It is not very glamorous. And I think that then we go back to, okay, what can we do to address this to make sure that is a fair landscape for our companies? Then you go back to tariffs, right? And as much as we dislike some of those characters, then we have to say that if you're trying to rebuild an industrial capacity when you have unfair competitors, then there aren't too many other ways than using tariffs.
Excellent. Exceptional insights, Benoit. I see that we are at time. It was great to have you back on the podcast. Very timely conversation. Don't be surprised if you receive a follow up invitation to join us again soon, just given the current environment. Thank you again.
Thanks for having me.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.